Let's look at the qualitative factors that determine materiality. First is non-compliance with laws, regulations, IFRSs, and contracts. If an organization does not comply with the laws or regulations, it means that it will have a higher risk. And once the risk is high, it means that the level of materiality will be low. Then measurement or disclosure of transactions with related parties. Like if an organization, like when they were preparing financial statements, they put disclosures and everything, it will mean that the level of risk will be low and the level of materiality will be high. But in case they didn't put disclosures and how they measured things and all that, the level of risk will be high and the level of materiality will be low. Then personal use of assets by management and those charged with governance. In case management uses some assets for their personal use, there will be a higher risk because some things will not be accounted for, or they might do something that is not clear. So the level of risk will be high and the level of materiality will be low. Another one is the existence of fraud by management. Where there is fraud, the risk is high, so the level of materiality will be low. Then key industrial disclosures, for example, research and development costs for a pharmaceutical industry. So where there are no key industry disclosures, the risk will be high and the level of materiality will have to be low. Then significant events and changes in operations. Like in case a business changes how it operates, that will be like the risk will be high. The risk may be of error. The risk of error and all that will be high, so the level of materiality will be low. Another factor is illegal payments or executive expenses and personal use of assets by directors. So in case such things happened, there is a possibility that maybe they are recorded wrongly or they are not accounted for. So the risk is high, the risk of misstatement is high for such things, and the level of materiality will have to be low. Then another factor is significant events, like unusual events. In case something unusual happens, for example, destruction of assets, in case there was a fire outbreak or floods or something and something was destroyed. So the higher chances that such things may be accounted for wrongly or not even accounted for. So they'll increase the risk of misstatement and then lead to low levels of materiality. Then another factor is any transaction that affects the going concern of the entity. And lastly is unusual events, for example, destruction of assets and then lawsuits. So those are some of the qualitative factors that determine materiality. Thanks for watching. Do not forget to subscribe, like, comment. Let's catch up in my next video.